Choosing commodity ETFs, how to avoid roll yield issues. Imagine trying to keep a balloon inflated while the air keeps escaping. That's similar to what happens with futures contracts in commodity exchange-traded funds. When investing in commodity ETFs that use futures, roll yield can make or break your returns. Roll yield happens because futures contracts have expiration dates. To stay invested, these ETFs sell contracts that are nearing expiry and buy longer-term ones. The difference in prices between these contracts creates roll yield, which can be positive or negative depending on the market shape. Understanding the market shape is key. When futures prices for a commodity are higher for longer-dated contracts than near-term ones, it's called Contango. Rolling in Contango means selling cheaper contracts and buying more expensive ones, which drags down returns. On the other hand, backwardation occurs when longer-dated contracts are cheaper than near-term ones. In backwardation, rolling contracts can actually add to your returns because you sell high and buy low. To avoid or lessen roll yield problems, look for ETFs that track total return indexes. These include not just price changes but also interest earned on collateral, which can help offset some negative effects. Also, pick ETFs that focus on commodities prone to backwardation. Commodities like precious metals or certain agricultural products often have supply constraints that push markets into backwardation, reducing roll yield costs. Some ETFs use smarter strategies. They might roll contracts earlier or later than usual, or use calendar spreads to minimize losses. These active management tactics can help avoid big negative impacts from roll yield. Always check the ETFs, prospectus, and past performance. See how they handle rolling contracts and whether they track total return indexes or just spot prices. Transparency about their methodology is important. Diversifying your holdings across different commodities and roll strategies can smooth out negative effects. Combining ETFs that have different market shapes and roll approaches helps balance the risks. Remember, the shape of the futures curve and how the ETF manages rolling contracts are the main factors. By choosing ETFs that focus on commodities with favorable market conditions, tracking total return indexes, or using smart strategies, you can better manage roll yield risks. Always do your homework on the fund's methodology and the underlying market dynamics to keep your investment on track.